Hello, today we're going to be going over Clover Health, ticker symbol CLOV. We're going over their Q3 earnings that just happened. Some things to highlight here, just right off the top, is that insurance MCR improved to 78.5%, bringing year to date MCR to 80.8%, which is really good. The insurance revenue grew by 12% compared to Q3 2022. So we've already been calculating a 12% growth rate, so that's good. Um, their net loss was 41.5 million. Adjusted EBITDA loss of 5.1 million, which is good. So they are expected for the full 2024 year for that adjusted to be um, positive. Scott said that right here in the quarterly results. It says our third quarter results reflect continued momentum towards sustained profitability. But it's talking about on the adjusted level, which you can see right here, and our ability to deliver profitability for the full year 2024. So as we can see here, compared to last year, insurance revenue was 301.2 compared to 26.9. We already know that they cut non-insurance revenue, so it's good to see that the insurance revenue is growing. Total revenue 482.1. Insurance MCR 78.5%, much better than the 86.3%. But that non-insurance MCR barely better than last year. It's at 104.1. We really need that to be low. We really need salaries and benefits to go lower. That's another thing that's hurting us. So the net loss was 41.5. But you can see they're doing much better than both these last year, so that's good. We would like to see them become profitable, of course, but their current guidance has been bumped up by a tiny bit. So now projected insurance revenue is 1.21 to 1.23. Non-insurance revenue staying the same. Insurance MCR 81% to 82%. They're still saying non-insurance MCR to 98% to 100% for the whole year. As we can see here, their current guidance is lower on both of these right here, so that's good. This one's significantly lower, so between 55 and 80 million, which is much better than a range of 70 million to 120 million. But salaries and general administrative fees only a little bit down. So the low end was 315, now the low end's 310, but the high end's 315. Insurance members is down significantly since last year to 81,000. Non-insurance beneficiaries, obviously they cut a bunch of people. We've already known that from previous ones. So this is just some of the things to highlight from their general earnings. There are some concerns going forward, obviously, with the non-insurance revenue. That's something that we'd like to see them improve, which would really help towards profitability. Um, Clover Health, if you come down here, their cash and cash equivalents is doing pretty good. They do have 147 million that they had to pay back to CMS, but their total assets is 1059797 unpaid claims, which you can see right here. Total liabilities, and then total stockholders' equity after you take away assets and liabilities, which is 321852. If we come over here, we're going to be using their average quarter revenue results that we've had so far. So basically this formula equals 508 times 4 to show you. So we're currently sitting at this for our revenue for the year, which is in billions, by the way, well, millions. So that's 2 billion. But we're going to times that by 2.5%. So we're using a 2.5% revenue right now, which is going to be 51. A 12% growth rate, as we saw with the insurance revenue. Discount rate of 10%, perpetuity 2%, 484 outstanding shares. This brings us to an intrinsic value of $2.77. I was going to do a few different things here today, so we were going to use a 12%, so it brings us to $2.13, and we were also going to use a 15%, which is $1.55. And the reason that we are doing that is because there are some red flags with Clover Health that we've seen still, especially with that non-insurance side segment, and then salaries and general expenses. So those are things that we want to do. But if Clover Health is doing really good, we'll go back to our regular 10% growth rate. We're going to go back, especially with the economy starting to go towards doing better in the long run, and them cutting interest rates. Let's just go back to if we were being aggressive. So we'll go ahead and do 102 based upon what we already have. We're just doubling that. So then we have a discounted cash flow price of $5.55. As you already know, Clover is trading under $1 again after earnings. So you would 5 times your money pretty quickly if it did reach these intrinsic values. We're not sure what Q4 is going to look like, but I will say Q4 probably won't be liked by the market because it is going to show and reflect those payments that they have to pay to CMS. So 2024 is going to be really important, especially Q1 of 2024, to really show how are we doing with the current members that we have, how many did we lose, how many did we grow. Um, we already know that new members are already expensive, so how much is this going to cost us, and is it going to cut in towards our profitability? Those are the things that we're going to need to know in 2024 very quickly. Q1, Q2 are going to be very, very important. If Q1 and Q2 aren't looking that great, and non-insurance revenue is still hurting us, Clover Health's going to have to make a lot of adjustments, and then we're probably, if that happens, we're going to be talking about reverse splitting, because we're probably still going to be under $1 for over 6 months if that happened. I'm not saying that's going to happen. I'm just saying these are the things that could happen. I do think that we have a lot of great people, with Vivek, Andrew Toy, Scott. We have a lot of great people. I think that Clover Health's going to be fine in the long run. But, these are things that we should start looking forward now, because you want to be ready before shit hits the fan. Now, as far as my intrinsic value goes, I'm going to be conservative with 2.5% of revenue instead of 5. So we're going to go back to the 51, 12%, 10% discount rate. We're looking at $2.77. Even with that 15% discount rate, like I was showing you, it brings it down to $1.55. So we're still looking at undervalued. Even using a 30% discount, $1.01. I mean, if you're looking at 89 cents today when I'm making this video for Clove, you're already going to make more than 10% of your money right there. So these are just things to take into consideration, why it's important to try to come up with some kind of value for things that you're investing in to know where you're sitting at. And this is how I'm looking at things right now, but I'll go back to the 10% discount rate, and then we're looking at $2.77. So I do think Clove is still undervalued. I do think Clove is going to do well long term, but there are things that we need to be watching out for. And another thing we need to be watching out for is their cash and cash equivalents. That'll be very important in 2024, especially as we're trying to move towards profitability. Thank you. I hope you guys have a nice day.